I'm Osborne Foreman, and in this video I'm going to analyse Lloyds stock by giving my views on the business and whether I personally would buy shares of LLOY right now. And if you find the video useful, please drop one of these to support the channel. Lloyds Banking Group provides a range of banking services and financial services primarily in the UK and operating in three core segments: retail, commercial, and insurance and wealth. LLOY are the largest retail and commercial banking provider with around 26 million customers via their brands of Halifax, Bank of Scotland, Lloyds themselves, Scottish Widows. LLOY is listed in the FTSE 100, has a market capitalisation of £27 billion and 63,100 employees. I would consider Lloyds to be an oligopoly market type. This is because a few banks dominate a majority of the market share, but individually none of them have additional marketing influence over their competitors. Furthermore, due to the complexity of financial institutions and a large variation in their respective industries, I would consider Lloyds to be in a fragmented competitor landscape, meaning that whilst they may be a market leader in mortgage books, for example, it's going to be very difficult to track across the board without doing a massive deep dive into the company. With this in mind, I believe Lloyds' closest competitors to be the likes of Nationwide, which is a building society, or the likes of NatWest, or formerly called Royal Bank of Scotland. These are both businesses that are domestically exposed to the UK, but also they have a very similar market share on the mortgage book, where I believe Lloyds competes the most. Even though Lloyds is the market leader, the two businesses are trailing behind by a fair margin, but between NatWest and Nationwide it is very close. Although I believe Lloyds has favourable competitive advantages simply from being a market leader, such as being more sustainable and therefore leading to better returns. This is because they're going to be making more money than their competitors. They're able to use this money to invest back into the business, be it higher quality customer service or the likes of polishing their own business process so that their margins are higher and they can invest even more back into it, or then reward investors with a higher level of dividend growth. Furthermore, due to their large size and scale, they're likely going to have a lot of a better efficiency compared to many of their peers that aren't as well exposed or diversified in the UK market. However, I do feel that Lloyds has a significant moat, and that is primarily due to the size of their mortgage book, as it is a much higher market share than their competitors, but also due to the customer service that they're able to provide. Whilst I don't have too much of a personal insight on these, I do use Lloyds as a bank, and most people I've spoken to, at least it's something like 1 in 4, I think, use Lloyds. But that seems to be the most popular in my opinion. And it's very likely they can continue to grow the size of their assets on the mortgage book. This could be either organically for more customers that are applying for mortgages, or it could be inorganically, like they had done in 2019, where they acquired Tesco Bank's mortgage book for £3.8 billion. And they have a lot of capital available, so they could acquire other banks' mortgage books to remain market leaders. In the last 5 years, Lloyds Bank has managed to grow their earnings by a compound annual growth rate of 11.6%. Which sounds a lot more impressive than it actually is, and that's due to the fact that in 2015 to 2016 they were struggling quite a bit, and this might be due to the claims of, forgive me, I'm going off the top of my head, but there was a 3-letter symbol combination that was really impacting the banks, and it was a sort of lawsuit due to offering some promotions in the past. I imagine this had strenuously impacted the balance sheet of Lloyds, and that's what led to financial difficulties, although I'm pretty sure that this expires very shortly or has already expired, so the future for the business is looking a lot more promising. But it does make their earnings growth look a lot more inflated than it actually is. What we can see in the last year is, despite the huge revenue decline due to the pandemic, their earnings, whilst yes they did decrease, they had proven to be very resilient and done well. As revenue had dropped, earnings had actually increased in the last quarter or quarter 3 of 2020. I suspect that this is due to the stamp duty holiday. The idea behind this was that more people would be going out and buying houses, pushing the price of houses up, but also increasing the overall demand of buyers, therefore meaning more people are applying for mortgages. And that's where Lloyds benefits, in my opinion, which had increased their mortgage book and is likely going to inflate their income as well. And if you'd like to sign up to Freetrade, which is my stockbroker, you can get a free share if you use the link in the description down below. If they're able to continually streamline the business as a market leader and also become more profitable, that does give a lot more room for capital to be reinvested back into the business to either improve their customer service and go down that loop again, or via dividend growth. Especially if we consider the period of 2018 to 2019, they were consistently holding margins of above 20%, which is very respectable for a financial institution, well, at least a banking institution without an investment arm. That's right, Lloyds doesn't have an investment arm, and that's why a lot of people perhaps prefer the likes of Barclays as an investment, as they still have their investment arm. And now I believe, but this is speculation, but I believe that in the great financial crisis during 2007, Lloyds TSB had to be bailed out, and this had meant that their investment arm was taken away, but I'm not entirely sure. What this does mean is that they aren't exposed to the markets, and I do think that's a higher margin market than they are currently in due to the low interest rate environment and mortgages. However, this does mean that there is more of an opportunity to purchase shares of Lloyds, as if interest rates remain low, this would seem like an overvalued stock. But as they start to rise again, Lloyds could become more in favour due to being able to offer higher interest rate mortgages. Although, how long will this take before interest rates start to rise again, and will they ever get that high? But this potentially gives them room to trade up on price to earnings or price to book valuations and expand upon their multiples. This means that if investors currently look upon this stock and don't value it too highly, this could mean that this could change in the future, and therefore, rather than their earnings growth, you could gain capital or shareholder returns via the valuation re-rate, which could fairly be due. And currently their price to book ratio is the same as the industry. But if investors become more bullish on this stock, this could become a much higher multiple like the market, which is 3 times as high. However, when looking at the balance sheet of Lloyds Bank, we can see that their short-term assets do not outweigh their short-term liabilities or long-term liabilities. Then again, I believe financial institutions have specific and more tighter regulations in place that impacts the health or the appearance of their balance sheet, and I believe this is because they have to write off a majority of their loans as bad debts, and therefore have to write off the idea of receiving the money back, and therefore it kind of makes it look worse as they prepare for a worst case situation, or a lot of those liabilities could be less of a liability than they truly are and be paid back. Although I'm not entirely sure on this bit, and whilst I've speculated in the past, no one has really informed me on the matter. What we can see is whilst their debt to equity ratio is high, their cash to debt levels are fairly reasonable. Their cash almost outweighs their debt, and it's only by £4 billion, which sounds like a lot for a £27 billion company, but their cash position is around 140 something billion pounds, and their debt is like 153 billion pounds. So there's clearly not much of a difference between them, but historically it was higher. The cash did outweigh that debt, so that is something to think about also. But then I would still consider them to be in a more secure position. That is plenty of cash to have available, and that could also mean that they're able to reinstate their dividend, which they have said in the last few months. I believe they said that they are able to pay a dividend, but they very much rely or wait on the Bank of England or regulating authorities like the EBA in Europe to give them the green light. And Lloyds were well known for their dividend, whilst for the first few years, let's say between 2000 to 2005, they were paying a dividend. They didn't grow upon it. The great financial crisis came, banks suspended and cut their dividends, and the whole industry changed forever. However, in 2014, they decided to restore their dividend, and each year since then, they had grown upon it slightly, except in 2019, in which we had the pandemic crisis. Even though it was 2020, the 2019 dividends are in 2020. It's very complicated, or it's not, it's just more confusing than it really needs to be, but it's just the way the graph looks. Typically, their dividend yield ranged between 3 and 6%, which would then pay in May and September each year, which are 2 fairly common dates. But I also remember hearing some articles on the fact that Lloyds could be transitioning to a quarterly dividend payer, Although I think this may have been more speculation than anything, but I did remember hearing that a good year or so ago before they had suspended their dividends. Although in the peak of the pandemic crisis, obviously they had suspended their dividend due to the pressure from the Bank of England and the European Banking Authority, I believe. So the idea was behind it that they would suspend paying dividends so that they would have more cash available on their balance sheet so that they could therefore lend out more money, which in turn would stimulate the economy. The trouble is with their dividend is when they were growing it between 2014 to 2019, it was inconsistent at best, and it had ranged from around 5 to 20% year-on-year growth. And the real question is, when will they decide to resume that dividend payment? I mean, do they really have a choice in the matter, as they are waiting on the Bank of England's green light? This could mean that if you were desperate for dividend income, or you are reliant on passive income in your retirement, and you're invested in this stock and rely upon it, in a crisis, the Bank of England may say, no, banks, you need to suspend your dividends, and then you aren't getting that payment which you may need to pay the bills, for example. And ultimately, the choice is out of their hands. Whilst they've stated that they have the capital available and could pretty much easily pay this dividend, it's not their decision to make. And this really would prevent them from being a true dividend payer, as if every single crisis they are told to suspend or cut their dividends. In the last 5 years, if you'd have bought shares of LLOY, you would have been rewarded or negatively impact and lost 26.7% of your capital invested, with dividends included. I won't lie, historically, after the great financial crisis, Lloyds Banking stock and many other UK bank shares have either been trading sideways or decreasing consistently over that time period. But that could mean there is an opportunity available, because at the moment it certainly seems like a lot of investors do not see value in these stocks. And being at a lower valuation now could certainly be advantageous for the future if they were to expand on those price multiples like I had mentioned before. At the same time, the bank is without an investment arm and is heavily tied to retail and commercial banking, where interest rates are at all-time lows. The UK economy is in a rougher patch due to a combination of the pandemic crisis and subsequent lockdowns and Brexit. This could mean that the UK economy struggles very much in the short to medium term. Lloyds Banking Group is heavily domestically exposed to the UK economy, and therefore means if the UK struggles, it's likely Lloyds will struggle too. But then if you believe in the short-term prospects of the UK, then Lloyds could be a good option to gain exposure into our economy. After all, we may see a very strong short-term recovery in GDP, as many households are saving more money and they're likely to spend it once the lockdowns are over. It seems like there's so much more factors to push the stock down currently than there is to push it up, which means that as these factors dissipate or be put to rest, for example, it would seem like this price could be unlocked further and you could gain shareholder returns. However, if I were to buy shares of LLOY, I would be very careful and put small, consistent sums of money into this position and make sure it does not become overweight in the portfolio. And that's because in the past it's been volatile at best and it's not really had a good track record of getting returns. And whilst they say past performance does not reflect the future potential of your returns, you should really also take it into account, as it may continue to happen, and it's best to at least have that in mind and prepare for the worst but hope for the best. And it could continue to decrease for the foreseeable future if they're unable to reverse that negative revenue trend. I personally would not buy shares of Lloyds Banking Group, and that's because they're a bigger company than I like to invest in. They're a £27 billion market capitalisation business. The companies I like to invest in are usually £10 billion or less, with a few exceptions. And despite their resilient earnings, their revenue has not been grown upon in the last 5 years without factoring the pandemic. However, for someone interested in gaining exposure to the UK domestic economy and would like to potentially increase their risk to reward ratio, then I could see value, especially if you're willing to wait for the dividend to be resumed, then I could see value in Lloyds stock. But in my opinion, a £27 billion company is unlikely to provide much capital growth, at least from earnings multiples, but rather it would be from valuation, re-rates, and in the UK markets, how big could they truly get before we reach a ceiling in which investors or funds have all invested into it and there's not much more money flowing in. And having little to no control over their dividend payments due to regulators is a massive turn away for me, and not something I would want in a time of economic uncertainty. If you're interested in how to build a monthly dividend stock pay rise portfolio, then click the card at the top right of the video. Thank you for watching. Have a great day.